Okay, problem number 3 here on monetary policy and the money market. Again, if you haven't done it, pause right now and try and complete the problem. The biggest thing that you're going to notice as we're moving through these problems is that they are getting a little bit more complex and tying a little bit more information together, and that's definitely true here. We're going to go from banking into the money market into an ADAS and then take that all the way through to some changes to lenders and borrowers. So part 1 here, we have a reserve requirement of 10%. Reserve requirement is 10%. We have a bond sale of $50 million by the central bank or the Federal Reserve. And we have a first question asking us what these policies are going to do to the money supply. So first reminder, the change in the money supply is the change in excess reserves times 1 over the reserve ratio, or the money multiplier. So the bond sale will result in a negative $50 million change in reserves at banks. Banks have to give away their reserve cash in order to buy the bonds that the Fed is selling. And that's going to be multiplied by our money multiplier, which is 1 over 0.1, which would be 10. So 10 times negative 50 would give us a negative $500 million change to the money supply as a result of this open market operation by the central bank of country Z. So then we want to carry this over onto the money market and show what happens to the interest rate. So money market QM versus the nominal interest rate, vertical money supply, and our downward sloping money demand, starting us here at RE. And so we said the money supply is going to decrease by 500 million, so we can shift this money supply to the left, and a leftward shift of the money supply is going to raise the interest rate to R2. So we can say a decrease in the money supply is going to lead to an increase in the nominal interest rate. Part 3, how is that policy then going to carry over to our ADAS model? And this becomes a good reminder that the Fed doesn't really care about the money supply, and it doesn't even particularly care about the interest rate. It only cares about these things in terms of carrying them over to an ADAS model, or carrying them over to the actual economy. So we can come over here and say on an ADAS model we have real GDP versus price level, and we can show a downward sloping aggregate demand versus an upward sloping SRAS, and start this economy at PLE, price level E, and output level E as well. And so we can say when nominal interest rates increase, then we know that spending, C and I, by consumers and businesses decrease, so aggregate demand will decrease. So we can decrease our aggregate demand curve, shifting it to the left, which will decrease output and decrease price level. This question specifically wanted the answer to price level, so we can conclude that price level in this economy will decrease. Question 4 then gets us to the kind of bigger connection. How does price level affect different people in the economy, or how does changing inflation affect different people in the economy? So a decrease in price level is equivalent to a decrease in inflationary rates, potentially even representing deflation. And so this is going to be good for people on fixed incomes. People with fixed incomes are going to be better off in this situation. And the easiest way to kind of make sure you're thinking this through appropriately is that a fixed income is a nominal value. So the nominal value is not going to change because it is fixed over time. Somebody is making the same amount of nominal dollars over time. But to find the real value of someone's wealth, we have to reduce or remove the change in prices. So we have to remove the inflationary change. So a nominal value, 0%, minus a negative value, potentially it's a decrease of 2% in expected inflation, means that the real value of this person's income and the real value of this person's wage is going to increase by 2%. 0 minus -2 is 2%. And the 2% here, again, is just a hypothetical, but we know that price level is decreasing. So if their wage does not change, but their price level does change, then they will feel richer and feel as if they have more money than they previously did.